Okay, now let's move on to what is another a document of prime entry like what we saw before, called the journal. Now, why is a journal required? Essentially, if you look at the other books of prime entry that we went through, there are many type of transactions that may not be able, we will not be able to capture. For example, when we take a loan, how do we capture in the books of prime entry we have discussed till now? Or for example, when a capital is brought in, only one leg of it, when the cash or the bank balance increases, we can bring in, but we cannot capture the other leg. So we need a system, as we have already seen, where both legs of all the transactions can be captured. Now that is where journal comes into play. As we go along, it will become more clearer. Generally, to understand the steps in journalizing, as we call it, is find out what are the two accounts that are getting affected. Okay, ascertain the nature. When I say nature of the account, what I mean is it an asset account, liability account, or an income account, or a expense account? Then based on that, is it increasing or decreasing? You find out what is the rule of debit or credit. That is, if it is an asset account, increase will be debited, decreases will be credited. So like that, you find out what is the rule. Then ascertain the accounts to be debited or credited, which are within the asset category. There could be a machinery account, or a computer account, or a vehicle account, or a debtor account, etc. So find out which are the accounts to be debited and what is the other leg of the transaction which has to be credited. Then write the name of the two accounts to be debited and credited, and write the name of the account to be credited, as I said, and then write a small narration which says why is this being done, what is the reason behind it, or what is the explanation to that transaction. Let's take a few examples to make it more clearer. Essentially, as I said before, remember, journal is something that is used for transactions which may not be able to capture in the other books of prime entry, but it can also be that a journal can be used completely from the, not using the other books of prime entry that I spoke about, and we can use the journal itself even to capture those kind of transactions as they happen chronologically. So all books of prime entry, you should remember, capture the transactions, the business transactions as they happen, and there is no sort of rearranging them to understand and gather information from them. As they happen, they are captured. So journal is one such thing, and as I said just now, you can still use journal itself without using the other books of prime entry, even to capture those nature of those transactions. So let's see how we do that. Let's take an example now. Say I start business with 4 lakhs of rupees as my capital. So what is the two accounts that are affected? One is cash account, the other is capital account. What is the nature account? Cash account is an asset, and by bringing in capital into the business, it is increased. So increase in asset means debit cash, and credit capital account, which is also an increase but of a liability to the owner. So both are increases, but one is a asset account, other is a liability account. So asset account increase is debited, capital account is credited, and we give a narration saying being capital brought in. Out of this 4 lakhs, 2 lakh 50 was deposited in the bank. So what has happened? There are two asset accounts that are getting affected. One is the bank account, which has increased by 2 lakh 50. So an increase in asset means debit, and cash account, which is also an asset account, is getting reduced by 2 lakh 50. So credit. So we write bank account to cash being, when you say write to cash or to capital, it essentially means crediting that account. So this is how we, as and when the transactions are happening, the journal entries are made, and we will see that from here on we will move into another part, the T account part, which is what will then capture the individual balances. So the third transaction here is goods purchased on credit from ABC Limited for 60,000 rupees. So what is a purchase account? Is a expense account. So purchase account you debit, and you have to pay whom? ABC Limited. It becomes a liability. An increase in liability means credit. As I said, if you would have noted down all the rules that we had initially mentioned, then from there you can ascertain what I am trying to say and relate it to. So again, I write a narration here, being goods purchased from ABC Limited. So here I have written a few narrations. In the other things I am focusing on the transaction, not so much on the narration in the future or the examples that are coming up. A computer is purchased for 50,000 rupees. Now what does it mean? Computer account is an asset account. It is increasing, so debit the asset account, and cash which is paid out is an asset account which is reducing, so credit cash account. Goods worth rupees 10,000 were sold on credit. Now this is sales to Messrs Chand Brothers. So Chand Brothers you have sold, he is a customer of yours, he has not paid you yet, so he becomes a debtor. So there is an increase in the debtor which is a asset account. So Chand Brothers you debit saying that he has to pay you 10,000 rupees, and what you have done? You have actually sold. So sales and again an increase. It is an income. Income increase means a credit to that account. Similarly, cash receipt for sale of goods to Reddy Brothers. Now this is a cash sale. This was a credit sale. This is a cash sale. Here the sales account is increased. Therefore, you have to credit because it is an income account, and cash account is an asset account, has also increased, and therefore there is a debit to cash account. Rent paid. Now rent is a expense account. So when expense increases, you will have to debit the expense account. What have you used to pay the rent? Cash. So cash is an asset account. It has decreased. So you credit cash account. Machine is received and payment is made by check for rupees 1 lakh. So the asset is machine, which is an asset account. The machinery account has increased, therefore you debit the machinery account and you credit another asset account which is bank, because you have paid out. So the asset account has decreased, so you credit the bank account with rupees 1 lakh.